Welcome back. My name is Chris Ashnelli. I get to build, buy, and sell simple profit businesses every single day. And today we're going to be talking about business valuations, right? So every single week, we survey about 50,000 profit-led business owners through our newsletter, Simple Profits, and we ask a question. We try to poll our audience in a sense of, what are you interested? What do you want us to create more content around? This past week, we talked about, would you like to know what your business is worth and how you can make it worth more? And overwhelmingly, the answer was yes, I want to know what my business is worth. And coming in a very close second was tell me how I can increase the value of my business. So that's what we're going to be discussing today. And if you stay with us to the end of this video, which is probably going to be a long one, I'll actually go through a worksheet that's a high-level business valuation worksheet, working through an example of Sally Sue with Sally Sue's Lemonade. Sally Sue's actually a character from my book that my daughter helped me co-create, and she drew a nice picture in it, and we go through this journey of Sally Sue building her lemonade stand in the book on bootstrapping simple profits. So we're going to use Sally Sue as an example, and we'll go through a valuation of her business to make it teach, train, equipped in real life, show, not tell in a sense. But before we jump into that, I'm going to go through 12 quick slides here to kind of lay foundational scope, what it is that we're talking about, and most importantly, why it's important for us as business owners to know this process, right? By knowing this process, we can then ultimately unlock the value from this process. So we're going to be talking about business valuations and building wedge equity today. And when we talk about wedge equity, what do we mean? Right? This is the core concept that we really, really want to hammer home. It's something that's unique to us, something that we genuinely believe in at Bootstrapper Capital, where we do build, buy, and sell simple profit businesses every single day. We acquire businesses, we invest in businesses, and ultimately what we care about is the wedge that can get built within these businesses that we're doing deals. So the wedge, if you look at this picture here, it's quite literally the triangle, the wedge. It's the yellow on this graph. And we're looking at the value of our business, right? On the X and Y is value of business, time in business, right? So if we do nothing on our business and the business stays the same in terms of value, that's the red line. If we take action to build wedge by unlocking value, that's the green line, increase of value over time. And the difference between doing nothing versus taking action is the value that's being created, which is the wedge itself, the wedge equity. And the reality is naturally, most businesses will naturally just build wedge over time. It's just a function of being in business by caring about what you do and being intentional and purpose driven. You tend to just happenstance, serendipitously build wedge equity. But the reality is if you know what you're doing and why you're doing it, you can then functionally know how to get it done, and you can actually manufacture wedge equity inside of your business, which is quite literally unlocking the value, right? So all of this yellow becomes profit in your pocket, right? This is how you put more profit in your pocket while you own the business, because you will build a better business. And ultimately, when it comes time to sell, which in our portfolio, we have a business brokerage called simplebroker.ai, where we help folks buy and sell businesses. When you go to sell, you'll be selling for more, right? And then in the middle, if you happen to need to go raise capital or capitalize your business, Bootstrapper Capital, we provide the most affordable and flexible performance-based capital specific for profit-led small business owners. So we know a thing or two about this. If you're going to raise capital while you own the business, you need to recapitalize. It's also how you get better terms when it comes time to capitalize, right? So quite literally higher valuations, better terms on investment, larger exit multiples, and more profit in your pocket while you're owning the business. Wedge equity matters. It's something that we should all care about, and we should ultimately want to know how to build it. So in order to build it, we got to ask ourselves, what is my business worth, right? We want to know what my business is worth today, set a benchmark. We want to know why the business is worth that. And then by understanding what it's worth and why it's worth that, we can then figure out how do I increase the value of the business over time, right? So these three things are the things that we want to ask ourselves every single day within our business. What is my business worth? Why is it worth that? How do I increase that value? The reality is ultimately what you're doing is you're looking at the other side of the table. You're looking at potential buyers or investors, buyers, investors of businesses They acquire assets. They don't acquire liabilities. So you're trying to convert your business from a liability into an asset, right? You want it to put more profit in your pocket, right? The things, free cash flow, future value of cash flow, right? So you're trying to think of it from the other side of the table. And by taking this pragmatic approach of, well, from their perspective of a professional buyer, what are they caring about? The same things that they care about is the things that you should also care about while you own the business, right? So you want to do these things while you own the business, right? For yourself. Do it for yourself before you do it for others. What we've simplified is a formula, and we call it the wedge equity formula. It's brand equity times operational equity equals wedge equity. This is how we quite literally can manufacture wedge equity, which again, wedge is the triangle. Wedge is what you're trying to achieve. Wedge is more profit in your pocket. Wedge is a more valuable business. Wedge is more money when you go to sell. Wedge is better terms on investment when you go to raise capital, right? It's a more valuable business. So we've created a formula, a simple formula to build wedge equity. And it's simple works, but simple's not easy. So we've simplified it to two things. It's brand equity, which is really the money's multiple, times operational equity, which is really the risk ratio, equals wedge. So when we look at this formula, the impact of the formula, like what does it mean to us, right? Sometimes you need to know, what this thing means to be able to utilize it, right? Just because it is doesn't mean it means anything to me. I want it to mean something to me so I can then go utilize this thing in my business. So that's the job to be done here is we want to share, what this means with purpose and intention. Because if you understand it, you can quite literally unlock value inside of your business. Or with us, we believe that we can get into any business, anywhere within, asterisks. There's certain asterisks, of course. Nothing is 100%. So we believe we can get in any business relatively at any time and build wedge equity. Impact of the formula, brand equity. So brand equity, you have the money multiple. I'm going to go into what the money multiple means, because when we talk about valuations, the money multiple is the most typical thing that you're going to hear. It's the conventional knowledge, right? The conventional wisdom that we have when it goes to valuing small businesses. And again, one of the asterisks here is any business can build wedge equity, but what we're covering today is most relevant for small or medium-sized businesses, specifically profit-led ones, right? So what multiple is the business trading at? The money multiple is ultimately, what the value of the business is based off of a multiplying effect that buyers will apply when looking at something. And the second little arrow here is like, are we talking about sellers' discretionary earnings? Are we talking about EBITDA? Are we talking about revenue? Like, what are we even talking about? And how do we apply a multiple? So for us, we try to baseline everything off of SDE, or sellers' discretionary earnings. And I'm actually going to go through what that means. And then again, when we get into the spreadsheet, I'm going to show you how somebody could get to SDE relatively simple. I tried to keep it simple in terms of the worksheet that we're going to work through. When we work with clients through our advisory firm, Simple Profits, it's a little bit more extensive of a process than what I can capture inside of a YouTube video. But for high level purposes, we'll be able to get into the weeds with it. So I'm going to show you brand equity and the money's multiple, not just tell you, right? Operational equity is the risk ratio. Again, conventional knowledge, conventional wisdom is it's a money multiple when it goes time to value my business. Not the case. That's something that we want to really dispel as authorities in this space who actively invest in businesses, buy in businesses, help people brokerage businesses through the buy and sell, advise folks through building wedge equity, and then a number of other services inside of our portfolio of companies where we help folks build, buy, and sell. One of the things we want to dispel is, that it's not just the money's multiple, you also have to take into account risk. So when you're a buyer on the buy side, you're doing a valuation of the business and then you're diligencing that business. The goal of diligence or due diligence is to identify the risk inside the business. And then when you're going to negotiate price and terms, you're trying to ring fence or mitigate or take away that risk, that perceived risk. That's the job of diligence in structuring the deal, right? So operational equity is the risk ratio. And what it ultimately applies to is the type of discount a buyer is going to look for when purchasing the business. And the discount could be something on price, or it could be something built into terms of the deal. When we're looking at operational equity, really the question that folks are asking themselves is, how transferable is this business, right? Because when I buy a business, I want to be able to take the business over. I want to make sure there's no downturn into that business, right? I want to make sure it's simple to transfer, right? So we're asking ourselves the transferability. And there's different components of a business or different aspects that affect or impact transferability of a business when you're looking at it from a deal side, right? Inclusive in that, you're asking yourself, is this something that's transferring as a liability, or is this something that's transferring as an asset? And we buy assets. We don't want to buy liabilities, right? Some folks, professional buyers, some private equity firms or other professional buyers out there may consider buying a liability because they feel confident in their ability to turn it or convert it into an asset, and they could get a great deal and build wedge themselves and make a profit. But for the most part, the job to be done when you're a buyer is you want to buy an asset, right? And if you're a seller, you want to sell an asset. You don't want to sell a liability. You don't want to sell somebody a job, right? Or don't want to sell something that can't be transferable and the business breaks, right? So there's things that we want to pay attention to that ultimately will help us reverse engineer equity. And when we think of ourselves over at Simple Holdings, which is the holding company that owns all these other brands that we operate, Bootstrapper Capital, Simple Profit, Simple Broker, SMB Bookkeeper, Profit-led, Process-led, People-led, right? When we think about these things, what we're trying to really focus on is how can we reverse engineer equity? Because we're trying to build equity. We're trying to build wedge equity. Again, wedge equity is the triangle. That's how you unlock value inside of a business. That's how you put more profit in your pocket. That's how you get higher valuations, better terms on investment, larger exit multiples when it's time to sell, right? We also want to always remind ourselves there's not just one sale. There's not just one exit, right? There's really 5 exits of ownership. And we should be building wedge equity at every single one of these exits, right? So we want to reverse engineer equity. And there's an approach to that, right? There's a way to approach, just like most things in life. Most things in life were built by somebody else, right? Once you figure out how they built it, you can probably replicate it yourself and do it yourself, right? We're not, it's not wizardry over here. It's kind of just follow a formula or follow a process. With our portfolio of companies, we promote the concept that you can control process, you can't control outcomes. So when we put accountabilities in place inside of our own portfolio of businesses, the companies that we own, right, the companies that I own, I'm putting accountability on process. I care about process and folks following process and taking control and accountability into process, not necessarily outcomes, right? Process is something that we can control to design or deliver outcomes, get us to outcomes. We want to be able to focus on what we can control. Approach is process. So in our approach here with building wedge, we've simplified it to 3 steps because 3 steps is simple, right? It's really a little bit more complicated than that. But we're going to value the business. That gets us our baseline. What is the business worth today, right? So again, it comes back to what is my business worth today? We're going to then get into why my business is valued that. We accomplish that by identifying the gaps inside of the business, right? So I'll show you that also in the spreadsheet. We identify gaps around either brand equity or operational equity, right? Then we're going to strategize and we're going to get super practical and pragmatic around how do you fill or remove the gaps. And if you know what the value of the business is today, you know why it's worth that, why it's valued that, because you're identifying the gaps through diligence. Then you can very quickly put together, and quick is like a relative word, you can intentionally put together a plan, a transformation plan to be able to fill or remove those gaps, right? Either fill the gap up or remove the risk, mitigate the risk. And that will help you increase the value. And that's how we increase the value over time, right? So follow these 3 steps gets into that. In terms of an approach to evaluation, this is a lot of words on a slide. So instead of just talking to a slide, I'd rather show you a worksheet where we're actually working through what this is, which is this is how you approach getting to sellers' discretionary earnings. We use sellers' discretionary earnings because it averages out. It's a way to stabilize what ultimately profit in your pocket is when you own a business, right? It's the free cash flow in a sense of a business once everything's normalized. And because markets get made, right? Markets are getting made. Supply, demand, there's an equilibrium. Markets get made. And there's these universal, drivers that impact a market being made. Because markets get made, law of large numbers, you typically can get to math that makes sense. And when you figure out, normalization of things, socialization of norms, you can ultimately lean into how the market gets made. You can understand how the market gets made, and then you can utilize that information to help you make better, good, timely decisions. So if I'm valuing a business, what does all that words mean? There's a lot of words, Chris. What do all that mean? What it really means is if I own something and I want to go sell something, I'm not just going to go make up a price, right? I don't want to just say, oh, this is what I think it's worth. What I'm going to go and do is research, and I'm going to understand what other people in the market are valuing it at. Because the way that other people see it, it doesn't matter what I think. It matters what the market thinks. It matters what other folks think, what other people think. So you want to go and look at what other buyers, what potential buyers are paying, what they think. By paying attention to what they think, you can then ask yourself, well, how are they getting to that price? By understanding how they get to that price, you can then leverage that. And by more people doing that, right? By more people doing that, what you're really doing is taking the risk out of the market, right? The risk of the unknown. You're making unknowns known, and you're pricing better. You're pricing more appropriate as a seller, right? So you're positioning the maximum value. It behooves everybody, right? Law of large numbers, humans, we're communal, right? We like community. We like to work together. It behooves everybody. It's in the benefit of everybody to kind of think about things in a standardized way. So if everyone's pricing something relatively similar, then ultimately when it comes time to sell, you can price what you're selling. And when it comes time to buy, you can price what you're buying. And eventually buyers become sellers. So you want to know where the normalities of or equilibrium of that market is, so that you can always stay within it and make good decisions within it. And then you can, cost of capital, cost of risk, all these other things, make good, timely decisions. Sellers' discretionary earnings is a way for us to normalize the income of a business in a way that everybody else does. So by all of us doing it the same way, you're normalizing this approach. The market gets made, and then we could actually apply these multiples that we were talking about earlier, right? In terms of a money multiple to value a business, right? So this is a table of where multiples of SDE are trading at based off of revenue ranges and then industry or niche of business. We keep track of this data all the time in virtually real time through simplebroker.ai, where we're aggregating thousands of deals, and then we're pulling in the information and we're trying to make better, smarter decisions using that information. So asterisk, this may be outdated by the time you're watching this video, but at one point in time, this was relevant multiples. So what you're doing is you're looking at the revenue range of the business, which normalizes the size, the stage of the business, and then the industry. And what you'll notice is that multiples go up as the revenue starts to go up, right? And this is a revenue range chart. We also have SDE range charts, and they're relatively similar based off of the standardized information across the board, right? So what you'll notice, though, in terms of scope of this slide, is as the revenue goes up, your multiple is going up. Now you got to ask yourself why. That's because the perceived value or the perceived risk in the deal goes down. The value goes up because the perceived risk is going down. We believe that the larger the business, the potential for a more stabilized operation, stabilized revenue, which there's different components that impact revenue, right? So when we're talking about pulling, levers to be able to build wedge. You have your brand equity, right? So from a brand equity perspective, that's impacting the revenue, that's impacting your money's multiple. You have your 4 pillars of customer acquisition, right? Cold relationships, warm relationships, earned relationships, paid relationships. All of these combined are the ways in which you can acquire customers. So you're trying to drive more customers at a lower cost, lower customer acquisition cost. You have your 9 C's of retention and value, which is what increases the lifetime value of a customer. You're trying to retain the customer for as long as possible by implementing these strategies, which increases the lifetime value, right? Reducing the churn, reducing customers you're losing. And then you have your diversification of your customer portfolio. The general common belief system is the higher the revenue of a business, the more mature the brand equity. The more of the 4 pillars you're utilizing, the more they're optimized, the more retention mechanisms are in place, and the more diversified the customer portfolio is. That's just conventional kind of like a perspective. Not always the case. So I went through this whole talk track to just kind of communicate, not always the case. It's what people sometimes think or feel, but there's a level of diligence that needs to go in to determining whether or not that's the case. That's what I'm going to go into in terms of this valuation workshop. Also, why we can't just look at multiples. It's why operational risk or the risk ratio needs to be taken into account. Because sometimes, revenue could be high from just 1 or 2 customers, and you don't have a very high diversified customer retention portfolio. So there's not a diversification of the revenue streams. You lose that 1 customer, you're losing your revenue. The business is gone. You could have $1 million customer and be a $1 million business, or 2 of those and be a $2 million business and trading at a higher multiple on the chart. But in reality, that's not the reality of the business. That's not the reality of the risk of the business, right? That business would not have mature customer acquisition pillars. It may or may not have retention, right? You better hope that it does, because if it loses the customers, it loses the business. But that's just a simple example as to why you can't just take these conventional norms of, let me take the revenue or the SDE and multiply it out. You got to care. You got to go beneath the hood, under the hood, and you got to look at the core of the business and start to identify risk. Really, the best way to buy a business or the best way to look at building a business is to understand risk and then focus on risk mitigation. How do I remove or ring fence the risk? If I can take away risk, then what you're going to do is increase the likelihood of an upside return or an upside reward, right? So you want outsized returns versus risk. It's the same as if you're investing in public markets, for example, right? You want to do that with your own business, and there's ways to do that. There's levers to pull to reduce risk and build wedge equity in your business, right? So we just talked about the brand equity, right? But there's also operational equity. And the way in which we accomplish that is we break down the business by exit. So there's 5 exits of ownership. And a business that's at exit 3, 4, or 5, right? Exit 3 is, you're exit out, and, exit 1. You want to exit out of your day job. You want to make your business your job. Right? Exit number 2, you want to stop doing the work. You want to exit out of doing the work. You want to start hiring a team, building a team. Exit number 3, you want to exit out of managing people, and you want to start building a business system. Exit number 4, you want to exit managing the business system or managing the business, and you want to start hiring an operator to manage that business. So first real true exit is exit 4. Exit 5, you want to exit out of owning the business. You want to sell the business, start maybe enjoying life a little bit more, right? So there's really 5 exits of ownership. And the functional, practical reality is the business system, right? The systems and processes in place that support a business to function efficiently and effectively are different by exit. And there's a lot of folks out there that talk about implementing business systems or sell business systems or things of that nature, or talk about, you need to standardize your processes and you need to implement a system inside your business to get repeatable results. It's all true, but it's true with an asterisk, and there's variables to the degree in which it's true, because I've seen in a lot of situations folks trying to push or force someone who's at an exit two to implement the type of business system somebody that's trying to get ready to sell would have, right? Not all systems are created equal, nor should they be, because at different stages and phases of your business require different things. So what we've done is we've simplified the business system by exit. And we've actually created 5 different variations or relative variations of what a business system could and should look like at the different various stages. And we've kind of simplified the approach to assessing, what a business has versus it doesn't. And that's a really simple way for us to then be able to make an assessment in diligence of where a business stands, right? Which identifies gaps, which identifying gaps then ties over to how you get to the valuation, right? So we look at operational equity by taking something extremely complex, which is a business system checklist based by stage of variables, 5, in a comprehensive way, brand equity and operational equity. And then we make an assessment based off of what is, like what exists versus what doesn't exist, and then in a grading of it in the middle, because there's always gray space. The other thing of operational equity that's a key driver becomes profit-led financial accountability. And again, we build businesses that are profit-led, right? And there's a process behind being profit-led to put more profit in your pocket. So you're taking risk off the table while you're running the business, increasing the likelihood of outsized return, right? Inclusive and profit-led financial accountability is also, setting targets, being able to measure what matters, understanding, how you're optimizing within that. It's an approach, right? So there's specific levers that you can pull to build wedge equity. That being said, let's actually jump in and work through what it looks like to value a business and pull some of these levers, right? So it's showing and not just telling. This is Sally Sue's lemonade stand. And when we're looking at Sally Sue's lemonade stand, we're going to approach it from a very high level evaluation. And we're going to go start to finish. And we're going to do it in a way where we're going to keep it simple for YouTube, but we're going to hopefully get into enough depth where there's rubber meets road in terms of context to the content. What we're looking at right here is we're trying to normalize sellers' discretionary earnings over the past 12 months. And what we'll sometimes do is you'll see a trailing 12 month, right? So a TTM, trailing 12 month. And what that allows you to do is normalize a business over a 12-month cycle. So you know where it's trending at today. And then what we'll do is then pull up historic financials and we'll normalize the business over a 5-year period of time. And the reason why we do that in terms of normalizing the business, and again, normalizing the business, what I mean is with sellers' discretionary earnings, what we're doing is we're adding things back, right? So we're starting with the net profit of the business. That's the bottom line of the business from the profit and loss statement. After all expenses have been deducted from the revenue, you're then adding back in non-recurring expenses. And by adding back in non-recurring expenses and adding back in the owner's discretionary expenses and adding back in the owner's salary and benefits, what we're doing, and that's what's happening here, is we're taking Sally Sue's information, right? So we're taking the net profit, the profit and loss statement. We're then adding back in, we're factoring out the owner's salary and benefits. We're adding that back in at a line item. We're taking the non-operating expenses. We're taking, which are one-time expenses, right? Or extraordinary items, meaning like things that wouldn't otherwise happen on a regularized basis. Same with non-cash expenses, which impact the P&L, depreciation, amortization, right? And then the owner's discretionary. What we're doing here is we're trying to add things back into the P&L that are otherwise impacting coming out of the P&L, reducing what it looks like, what the number looks like. So we're actually increasing that bottom line number by saying, hey, just because you own the business and these are expenses that you incurred on this P&L, when you transfer the business to me as a buyer, I may or may not incur these same expenses, right? I may or may not take this salary as an owner, right? The one-time expense that you paid for a CPA to review financials and preparing for the sale, that does not get incurred, every year when I take it over, right? So you're trying to take the things that are, things that won't be normalized after the sale gets made, and you're adding it back in so that you then have this seller's discretionary earnings, which shows more of an adjustment of what the actual P&L looks like or profitability of the business. So in this situation, we took the 55 and we added back in all of these things and we ended up at 110, right? So when we're going to do the multiple, it's going to be a multiple at 110. Or what I'm about to show you is something that is a little bit better in terms of normalizing, right? But we're adding back in order to normalize what it is in terms of, again, a simple way to think about it is profit in your pocket, right? Once we get 12 months, which is the number that we're going to benchmark off of, we then want to go back and say, okay, is this normalization normal, right? Because even though these are numbers from the last 12 months, and what we're trying to do is get to a fair, a fair money marker so that we can get to a market rate equilibrium, right? Like a normalized rate so that, again, markets can work with equilibrium and the numbers make sense, right? However, just because these were the numbers for the last 12 months does not mean that that's 100% indicative of what we should factor everything off of, because what I want to know is law of large numbers over time. So I want to know a stabilized basis of the business, because if this is, something that only happened for 12 months, that's not something that we're going to factor things off of with a high level of confidence. There's going to be a risk that's associated with that. So what we'll do is go back to historic financials and we'll make sure that everything feels normal in terms of the growth rate of the business over time, right? And that there's no outliers of information. Because if it's like, one scenario could be, back in 2018, maybe the business was doing $2 million and now it's doing 100K, 110K, right? I'd be asking questions, why, right? Is this a trailing business? Because if this business is in a downturn, there's a reason why. There's risk associated with that. Is it going to continue on that rate to the point of zero? So I need to really be discounting this thing pretty heavily when it comes to price or terms, right? If it's an increased rate, I want to know that, because then I can forecast out what that growth rate is. So what we're trying to figure out is if it's a positive or negative growth rate over time, averaged out. So what we do is we pull the last 5 years of financials and we're getting to SDE for each of the 5 years. And this is a simple way of getting to SDE versus a line itemed way, right? On a trailing 12, you're taking your net profit, you're adding back in owner's comp, interest, taxes, depreciation, amortization, and that's getting you to the SDE number. You're then taking this SDE number, you're averaging it out, and then you're dividing it out, and you're getting a growth rate, which will be positive or negative growth rate. If it's a positive growth rate, that's good. If it's negative, it's cause for concern to think about going deeper or maybe stop looking at this deal entirely, right? In terms of a positive growth rate, what we then take is the existing growth rate and we apply it on the SDE from the last 12, trailing 12, 110, and we'll apply it out. And we start to benchmark off of this. And this is what we believe to be a fairly fair approach to benchmarking into the valuations. So we would give this a forecasted SDE of 115. And that's what we're going to use as a baseline. If we were to look at buying this deal, that's what we would look at as a baseline to be able to build around, right? So we took SDE from the last 12. We took SDE from the previous 5. We're inventorying all of the raw assets, furnitures, fixtures, etc. And then we're going to look at the base earnings multiplier. And in this business, this is a productized services business, right? So we're selling lemonade. It's a lemonade stand. And we categorize that as a productized service business, and revenue ranges up to $250,000 right now. So in this situation, productized service at up to 250,000 is trading and market at a multiple of 3x. So we're going to take a 3x multiple in terms of valuing this, the base earnings multiple of this business, right? This data changes all the time. We update our information on a weekly basis when we're working through this. You should always make sure you're working within at least quarterly norms, inside of your data set that you're optimizing around. Okay, so now we can get a base multiple, a base level of assessment. You're taking your 115, you're multiplying out by 3, and that could get you to your money's multiple, right? So that could get you to your initial base level assessment. However, what we want to take into account is the risk, right? So we want to get to the risk ratio. In the risk ratio, we're assessing brand equity and we're assessing operational equity. And we're going to start with brand equity first. And the way that we map out brand equity when we're working with a business is we map out the customer journey. So that's not shown here. This is just a byproduct of doing the work. But the customer journey map is quite literally how revenue flows through a business and the processes in place to be able to support it, right? So we look at each of the functional components of a customer coming through from acquisition through retention, right? Referral and retention. And we're identifying the things that go in. And in that assessment, what we're looking at by understanding each individual business, it's the most bespoke way, granular way that you could look at any individual business is mapping out, quite literally mapping out the schematic of that business by putting in the time, effort, and energy to map out the process. And, in terms of mapping out process, what that could look like, I don't have it here. What that could look like is, I don't have it. So what that could look like is quite literally all of the steps, right? You could just quite literally map out all the steps, process mapping, and then you can do a schematic of what those steps look like. What you're ultimately able to identify are the pillars in terms of the revenue pillars, right? So we have our 4 pillars of customer acquisition. We're identifying which of the 4 pillars of customer acquisition are being utilized by, again, mapping out the journey of how customers are getting acquired. If they're not, then we're assessing it. If they are, we're assessing it based off of the quality. And then we're assessing why, and inclusive of why, how we could improve it, right? That gets us to a score around the revenue pillars. We then repeat that process around the 9 C's of retention and value. So then again, we're looking at the business and we're assessing from a breakdown of the business what it looks like in terms of the mechanisms in place to be able to retain the value of a business. Consumption, collateral, cost of switching, choice, control of money flow, cause, community contracts, and communications. And we're going through and we're assessing, the score basis based off of what exists versus what could exist inside of that business. And then we're averaging it out. And then the same thing in terms of looking at the existing customer base and the diversification of the customer portfolio. And we're giving it a score and we're assessing it out. We're normalizing the score. So if something's not relevant to the business, you're removing it. And then you're taking all the scores, dividing it out, and you're giving yourself a brand equity risk ratio. We're going to take this and we're going to save this and table it, and then we're going to apply it to the money's multiple in a second. In terms of moving forward, we then look at the business system. In the business system, we're assessing where the business is at today. We're assessing where the business is at today based off of a checklist approach. In that checklist approach, we're saying what exists versus what doesn't exist. Let me just request access here and see if I'm able to get the access while I'm recording this video. We look at what exists versus what doesn't exist. And let's see if it exists anywhere else here. Business system. No, it's just a spreadsheet. So we're looking at what exists versus what doesn't exist. And then we're saying, based off of a score of does exist, doesn't exist, which is a 0, does exist or needs work, and then does exist is good. We're normalizing the checklist of the business system, again, based off of exit. So we've broken down the business system by five different versions for 5 different versions of the exit. And then we're assessing based off of a checklist, whether or not we're good, we're in good standing, right? We're then taking that and we're looking at the operational components of the operational equity. And this is on a more intrinsic level of the business system, assessing risk and risk ratio. And we're going from operational foundational risk to people risk to innovation risk, which is also to a certain extent legal, financial readiness, metric-driven operations, optimal profitability. And we're looking at each of these different various line items of the business, and we're rating it and scoring it. And we're doing this, again, off spreadsheet on a line item basis based off an assessment of the business today from a perspective of diligence, right? We then follow the same type of approach. You're going to average out the scores, and that's going to get you a operational risk ratio. And then when we're getting into the valuation of the business, we're calculating the valuation of the business over time by applying what the money's multiple was, right? And then you're taking in the brand equity, the business system, and the operational risk, and you're averaging them all out to an overall risk ratio. And then we're adjusting that multiplier. So we're taking that 3x base multiplier and we're doing a risk adjusted multiplier, which gets us to 1.72. And then you're taking this 1.72 and you're going back to your SDE, which is 115, and you're applying that out and you're getting a low, medium, and high value marker. And then you're normalizing those, you're averaging those out. So this business, based off of the brand equity that it has today, the money's multiple, and the risk associated with assessing this business from a diligence perspective, we're valuing this business at $154,000. So somewhere within this becomes a range that you could discuss, and you have price. So this gets you price, and then you have terms of a deal. So when it's getting back to building terms. Now, because we've been able to do these assessments, because we looked at the diligence, again, I just did this in a very quick video on a spreadsheet. Let's see if we actually got access to this here we go. So I can actually show you the business system checklist. So this is what the business system checklist based off of exit 3, which we want to stop managing people. We're looking at what goes into creating a complete business system by exit, right? So we break it down by exit, what a system looks like, and then we're assessing the status. Based off of that, that's how we got this business system checklist, risk ratio. So you got your brand equity, your business system, your operational. That then applies to your adjusted earnings. Because we're taking such a granular level of approach to each one of these, right? Which we're using different approaches, processes to be able to go deeper into the business that can't be shown on a high level spreadsheet, YouTube video. We're then assessing the gaps. And again, it becomes the value of the business and then identifying the gaps so that when we can then put together a plan to actually fill or remove those gaps, right? So it's a very practical approach in terms of how you accomplish this goal of building wedge equity, right? So by following this, you can get to your own valuation. You can get to your own business valuation. What is my business worth? You can understand why my business is worth that. And then ultimately at the end, you can show and land with a plan of how I can increase the value. Because by understanding, why and where the gaps live, you can then get very specific on a line item basis of where we're focusing to be able to improve these scores over time. And it's a scorecard based approach, right? So then you're taking this, you're then applying it to a measure what matters. And then systematically over time, you're putting a plan in place to be able to implement and build wedge equity and ultimately unlock value in your business. Unlocking value in your business is going to put more profit in your pocket while you own it. It's going to get you higher valuations, better terms on investment, larger exit multiples. Appreciate you. If you watched to the end of this video, please like, please subscribe. If you're not already, we're trying to build up this channel for sure as we help more folks, specifically profit-led business owners, unlock value inside their business, build a better business over time. If you want to do so, you can do it over at our community, Bootstrapper community, where we build better together. And then it's a great entry point to be able to get access to our advisory team and our performance-based capital and all the other things that we have. If you haven't checked it out already, we just launched a shop where you can get access to a ton of different digital products. And we're running a lot of different promotions in terms of, creating, more affordable and flexible access to more solutions that you can be able to leverage. All of those solutions, if you go and check out, they all get you access to the community, which ultimately gets you a personal exit plan. So you can at least start this process and start working with one of the members of our team to be able to work through building wedge. Till next time, trust the process, commit to the journey.